looking at this room, I can't really figure out, how many people have been in this market, investing in this market for more than 25 years. But I remember my early days in journalism around 2000. I mean, it was not unusual for the main indices, Nifty and Sensex, to go up and down 3%. It was easy. A bad day was when the index fell 5%, a really bad day. And a day where the index actually fell 10% and trading had to be halted. So we've seen things like that. Today, it doesn't look like the markets are volatile at all, because at every selling, you see buying. Nevertheless, one of the aspects that most investors fear the most about equity markets is the fear of this up and down. How much ever we say that over the long term it gives you good returns, I think Indians have not experienced, except for the last 5-6 years, that this volatility or up and down is really worth investing in or buying into. But then the volatility, uncertainty, the fear, all of these are the very core foundation or attributes because of which equity markets thrive and give superior returns. So first thing I want to ask you, Sandeep, you've been a private banker, investor, now you have this investment wealth advisory firm, which you're building beautifully. What is your perception of how people think about volatility? What are some of the things that you, as an investor, as an individual investor, thought about, and how have you used that in, laying the foundation for how Dezerv goes out and tells the story of compounding?
Mahalakshmi, thanks so much for having us here. A part of the question's answer was in your question itself, but let me take a step back. The fact is that while investing, nobody really envisages volatility, right? And in some sense, volatility is the price that you pay for compounding, right? And when you think about the compounding formula, right, it's the amount that you invest, the return that you get, and the time that you invest for. And if you think about it, out of these, what's essentially in your control is not the return, which is where most of us focus our time and energy on. To some extent, it is the amount of capital, but that's guided by the amount of savings that we can have and what kind of spends do we have. But really the only factor that's somewhat in our control is the time that you invest for. And when you think about the extent of time, let's say investing for 10 years, 15 years, where do bad decisions happen? It's at periods of extreme volatility. It's either when markets are doing exceptionally well, then we get carried away and overinvest, or when things are down is when we tend to exit the markets prematurely. India has now, in the last few years, or at least for the last year and a half or so, seen another version of volatility, which is no return for an extended period of time. It's gone through a time correction, right? And these are times when people's sort of patience is being tested right now. We see a lot of clients, or even when people are reviewing their own portfolios, think about the fact that last 1 year, markets have given lesser return than fixed deposits, right? That's colloquially how people refer to the fact that their opportunity cost of investing has been high and that they've not been rewarded for it. I think in this period of time, there's really no solution other than wealth managers really hand-holding clients and talking and reminding clients about the longevity of the time for which they're investing, right? And how the fact that if you miss a certain number of days in the market, you actually miss most of the returns in the market. Because like you said, you don't know which day markets will be up, which day you will have that 5% rally, right? But staying invested is important. That said, it's not to say that equities is the only asset class that we need to make money out of, right? Fixed income has done reasonably well in India. Short-term rates are reasonably decent. Gold and silver also merit a reasonable allocation in the portfolio. We think up to 10% of the portfolio should be allocated there. And then there is international assets which merit some allocation, right? So it's that creating that overall portfolio that becomes really important. a lot of our time and attention is focused on the number which moves every day on the screen, which is the price of the Nifty or the price of gold. And sometimes those numbers going up and down draw too much attention, much more than we should give it.
You know, one point that I want to pick on that you said, which actually quite stunning, that you're saying clients are already asking you, or you see people asking, why should I invest in equities, because in the last 1 year you've had flat returns. And by the way, this year till date, it's not flat, we are up 9%. On the Nifty. Of course, people are hurting because in small caps and mid caps, you've seen far more serious falls. But in 1 year, people are asking you this question. Does it tell you something? Is everything that we've been talking about, is it going in vain? Is it one of that investor mania that we've seen for so many cycles that you see again?
Manashvi, the more things change, the more they stay the same, right? And I think it's relevant that people get worried about their portfolio not giving great returns. If you see, let's say, last 14, 15 months, and especially folks investing in individual stocks have seen a situation where while the index might seem flat, the median stock is down much more, right? Probably like down 18% if you think about the median Nifty 500 stock, right? And that's something that potentially worries a lot of people. Most of the portfolios were built in a time of markets were reasonably up. If you go back to 2020 and the troughs of 2020, and since then is when most people at home started investing, I think they saw that bit of a rally and then a little bit of stagnation and some down if you especially had direct stock portfolios. I think that right now it's not in that frame where people are exiting equity markets just yet. But certainly the sense of impatience is beginning to kick in. And that's again really where the role of the wealth manager or advisor comes in.
So what do you tell people who are asking you this question that, hey, last 1 year I haven't made money, should I switch back? What should I do? What is your answer?
I think first is our job as somebody who's trying to educate people about the markets is to de-link the orientation towards past performance. The assumption that the great returns of last year will get replicated or the negative returns of last year will get replicated into time in the future, right? So I think just walking everyone through that concept, that what has happened in the last 1 year is definitely not a reflection of what is going to happen in the next year or the couple of years after. In fact, almost certainly you'll get it wrong, because if the market has given 10% return the last year, it will not give 10%. It will either give 12, 15% or 7, 8% or negative. It will certainly not give exactly the same return. So you're sure to be wrong if you assume that that's the same return you're going to get. The second is, I think, to some extent, if you think about what kind of post-tax returns different asset classes are giving and walk everyone through that. While fixed deposits might be giving 7, 8% or 6, 7%, the post-tax returns on them are significantly lower than anything else that these clients will do over a long period of time. And then reorienting back to the fact that this is money for a certain period, that this is not capital that they might need in the near future. I think those are conversations that need to be had, which is why this entire process is more consultative rather than instructive and telling people that this is what you should do, but it's more like what do you collectively think together, both as a wealth manager and as the owner of the wealth.
Okay, I'm curious to understand this messaging a little better, also but for the benefit of this audience and a lot more people who are watching us on Moneycontrol. Is, when we say post-tax, you are better off than debt, people tend to compare it or think about it like this year, like you started saying that this year we have just done as well as debt. But when you see a 25% drop in your portfolio, like small caps, you have seen that kind of cut, even in funds. What do you tell them? Because 25% cut means next 3 years debt returns is gone. So what is the message to that investor? And how do you shift this thinking? Of course, we say you can't look at it, but how do you explain to them?
I think, Mahalakshmi, courtesy of all the work that media platforms like yourselves have done, and in general the education that a lot of people in this room have contributed to, I think there is some appreciation of the fact that there are different asset classes And the question is on how much to allocate to which asset class, right? Today, when we look across portfolios, we do find over-diversification. But at the same time, we are not seeing portfolios getting hyper-concentrated towards small and mid caps, right? So the average portfolio, while like individual stocks have fallen that much, may not have suffered that much. So I think while there is downside, it's not as bad as what we might assume in 18-20%. Is that a kind of downside? Absolutely not, right? But I think clients are willing to engage, right? And if you think about the fact that these are not people investing for the very first time, the fact that in the last 4-5 years they've experienced some bit of volatility, sure they've made money, but there is openness on most clients' part. I think that's something that we hope that more people will exhibit, which is the fact that be willing to look at data, be willing to engage with data over a little bit of a longer period of time, and when you look at those numbers, it's not as bad as what looks in the short term.
Can you take us through some of the most common pitfalls in investor portfolios? What are the common mistakes that investors generally do? I mean, you've always said that it is not about bad products. Most people, the products are not bad, but it's just that they've over-diversified or it's not aligned to their goals. 2 or 3 thoughts there.
The first common problem that we see is reliance on past performance, is that we're making investments into selecting mutual funds, stocks, or even other asset classes on the assumption that the last 1 year return was great, and therefore these assets will continue to do as well in the future, right? So that is one part. The second part is over a period of time, as more people talk to you about investments and you hear about more stocks and individual mutual funds, you tend to get over-diversified. We've seen individual portfolios with maybe 70, 80 mutual funds and maybe 30, 40 stocks over, let's say, a portfolio of 1 to 2 crore rupees, right? And now that's clearly over-diversification that's happening. And the third is the tendency to churn or act on the portfolio more often than you should. There is, this F&O has been a big part of allocations for a lot of people who are spending time on the trading screen. And I think that has led to enough losses, and SEBI has also written about it. So I think those are 3 large areas. The first being reliance on past performance, the second being over-diversification, and the third being some trading activity that the portfolios have had.
Right. Are these also the same mistakes that, very rich people, family offices, businessmen also make? Because this is one cohort, last 3-4 years, there has been significant selling from promoters. A lot of that money also got rerouted into equity markets. And that money is also getting a little impatient now. That do they inherently feel that, if my business is valued so highly, I'm not so sure there is so much money left on the table in markets. And what do you tell them? What is the case for them?
Look, I think we believe wealth solves a lot of problems, but wealth also comes with a set of problems, which is the problem of choice, right? The moment you have, let's say, 50 crores, 100 crores plus, you have a situation where pretty much every asset class is within reach. And at that point, there is a tendency of evaluating things for the sake of novelty, right? We've seen this happen that some of the simpler investments, including mutual funds, potentially the most tax efficient, best governed, the allocation that such investments should have to large portfolios tends to go down. And there's an increasing allocation that happens to alternatives, in some cases individual investments. Now, when you think about individual investments, there is a concept of adverse selection, which is that when an idea comes to me, and I'm a family office running, let's say, 100 crore portfolio, one of the questions at least should be asked is, why is this idea coming to me, and why have institutional investors not gobbled it up? Because if you think about from a promoter standpoint or from a founder standpoint, they would want large single institutions in the cap table for most part, right? So I think those are the questions and the problems that family offices face, that because of choice, the allocation to exotics and alternatives becomes much higher, whereas sometimes the real opportunity is in plain sight, which is mutual funds and simpler investments.
Right. Tell us, what are you doing differently at Dezerv Are there any products, features, things like that that truly differentiate you? And I want to ask you another question, because this past performance should not be relied upon is like, this eternal truth that has been spoken for many, many years, not only here in India, but US and everywhere else.
It's a standard disclaimer.
It just doesn't change, right? It doesn't change investor behavior. Now, my question to you is, as media, as agencies like, Morningstar or Value Research or, even the industry, we continue to show 1 month, 3 months, 6 month, 1 year performance. Is there a need to completely, if you were to truly bring about this change in investor behavior, should all that be banned? Would it be an ideal world to have performance for equity funds be shown only 3 year onwards or whatever that time may be? I'm not sure. Some people these days recommend have 7 year holding period. So maybe 3 years, maybe 5 years. How will you as a wealth advisory platform react to it? How do you think the industry will take to it?
Well, Lakshmi, the fact is that the moment you ban something, there is greater attention to that, not less, right? And the way I think about it is that the NAVs are in the public domain. Pretty much everyone can figure out, even if I don't put it out there, what the 1 month, 3 month, 5 or 6 month return is. People will see it, right? I think it's more the education around the fact that that's not the only thing and that we should rely on. There are alternative data points that probably also need to be spoken about or written about. There is the concept of rolling return. And I know some industry participants have spoken about 3 year rolling return as being some of the data points that we should put out. Even that in itself is not sufficient, right? Because the assumption that 3 year rolling return will replicate into the future is something that we shouldn't assume, right? And therefore, the way we think about it at Dezerv, and you spoke about what differentiates us, it's not about what investment solutions I offer, but how we run these investment solutions. Our thought process is that our selection should be more data-led, and the data should not only be past performance, right? Today, when you look at the macroeconomic situation, you can evaluate or assume that certain styles will do better, or certain styles of investing will do better, and within those styles, which are the individual fund managers or assets that we will have, is a function of the micro parameters of that particular asset. The reason we do this is because not only are we saying that data-led investing does better, in some sense, we are also getting out of the way. Because as wealth managers, as investment advisors, we are also human beings. We also have our biases. By making sure we have robust frameworks running portfolios, to a large extent, we can eliminate the bias. Can we fully eliminate human insight? Absolutely not. There needs to be a layer of check at the final stage. But largely it should be driven by data-led processes, and that's something that we strongly believe in. This informs everything that we do, whether we create mutual fund portfolios or portfolios of boutique fund managers or even other asset classes. This is something that's fundamental to us.
Right. Is there any one money mantra that you want to emphasize as a closing note?
I think
your own personal money mantra.
My personal money mantra is to make life as simple as possible. And I think
it's a life mantra.
I think it's a money mantra also, but I wish I could live it better. For me, most of my allocation is towards mutual funds, and to the point that some of us in the industry have access to some of the most exotic investments out there. But really, like I said, real return is lurking in plain sight.
So what does simple mean in mutual funds? Sorry, I'll take 1 more minute.
When I say simple, I think
index funds.
No, I'll come to that. And we have a view on that as well. But 7 to 8 mutual funds pretty much, but actively looked after, gives you pretty much everything that you need in the markets. When it comes to index versus active managers, honestly, we are not in a camp. There are times when we believe active management does better, such as these. And there are times when it's easier to hold the index and keep the cost low. So I think it's about being objective and thinking about at that point of time what is right for the portfolio. But really 7 to 8 mutual funds should be good for 70 to 80% of the portfolio.
All right. On that note, thank you so much, Sandeep. Such a pleasure talking.
Thank you, Mahalakshmi. It's been a pleasure.
Welcome to Moneycontrol, your ultimate destination in the ever-evolving world of finance, business, markets, policy and technology. India's preeminent news platform, driven by facts and fueled by data. A platform made in India, and for the world. Moneycontrol.com has a staggering reach of 100 million plus monthly active users and 6.02 million daily active users. Being a transformative digital force, reshaping how we engage with money, markets, and news. Setting us apart is our commitment to delivering accurate information and empowering financial decision-making in a dynamic ecosystem. Seeking a deeper dive into the financial realm, we present Money Control Pro, a powerhouse of exclusive insights, providing actionable investment ideas and expert analysis. Because in today's fast-paced world, informed decisions demand both information and expertise. And we have 1 million plus Money Control Pro total paid subscribers and 100% return in 1.5 years, beating the market. Explore market trends, access expert opinions, and utilize essential financial tools all at your fingertips. Join the millions who trust Moneycontrol.com for their financial journey, where facts meet finance and data drives decisions. Think markets, think Money Control.